Good afternoon, everyone. My name is Steve Jewell with Community Giving, and welcome to today's Community Connections webinar. Today, we're going to be talking about investments, a topic that's on a lot of people's minds. We're going to give people just a couple minutes to get into the room or to log on, and so we'll get started here in just a minute or two. Okay, good afternoon again. My name is Steve Jewell. I'm with Community Giving, and we want to welcome you to our Community Connections webinar series. This is our 12th webinar that we have done since the stay-at-home order with COVID. We know many of you are with nonprofits. Some of you might be donors or fund holders. In either case, we want to thank you for all the great work that you're doing, either on the front lines, addressing the needs of the community, or as a donor, being generous and sharing with your resources to help provide support to people in need. We've been all kind of thrown for a loop as we've had to adopt to the new normal. For us, creating this webinar series was important just for us to stay connected. So again, we really appreciate you and thank you for tuning in. And we're excited about today's webinar because I know we fielded many questions over the last several weeks about investments and holding investments. And when we see this kind of market volatility, we go to the experts. And so we're very fortunate at Community Giving and with our partner community foundations to have some phenomenal resources that we can pull on to be a part of assisting us in our work. And we're very pleased to be able to feature them today. I do want to say just in a couple housekeeping things, we will have time for questions and answers at the end. But feel free to, as questions emerge, just type them in the Q&A tab at the bottom of the page, and we will have our speakers answer those questions at the end. And again, I think everybody will be put on mute, and we are also recording this so that if by chance you have to leave, you will get an email, and we do have these also on our website so you can watch this at a later time. So once again, thank you for joining us. Today's topic is on managing endowments during times of change and volatility. And like I said, we have some fantastic resources, all of whom play key roles in advising us here at Community Giving. Our first speaker is Shale Lapping. And Shale obtained his undergraduate degree from the University of Illinois, where he graduated Phi Beta Kappa, his MBA from McGill University in Montreal, and his law degree from the University of Chicago. Prior to the investment field, Shale practiced corporate law for 6 years, specializing in a broad range of legal and investment issues that impact various types of trust funds. Shale began working directly with the investment community in 1989 when he joined the firm that served as the predecessor to IPEX. Shale was vice president of that firm for 7 years and has been president of IPEX since the firm's inception. And as I said, we've had a relationship with IPEX for several years, and we really appreciate all that Shale does. And we're very happy that he is able to join us by Zoom today. And so I'll turn it over to Shale Lapping.
Great. Thank you very much, Steve. And welcome, everyone. It's great that we have the opportunity to be here today, and along with my fellow panelists, look forward to being able to converse with you on some rather timely topics. And the title of our presentation, as you well know, is Managing Endowments During Times of Change and Volatility. However, I would add if that was all we were experiencing, we probably wouldn't be having this call today. Because the reality is change and volatility are the norm in the investment markets. They're something that we experience all the time. What's a little bit unusual as of late has been that we're experiencing extreme change and volatility. And we've experiencing that on many fronts. We witnessed that first on the downside in the markets. We're witnessing it more recently now on the upside in the markets. In addition to what's taking place in the capital markets, both fixed income and equities, we're seeing a lot of robust change taking place on the social and geopolitical fronts. So really, no matter which direction you're looking at right now, an awful lot is going on. There's almost an infinite amount of statistics that I could quote you to back up some of those assertions, but I'm going to limit myself to just a few, as I know that both Brad and Jeff will be covering a number of those items in their presentations as well. If we look back to just the first quarter, which is not that long ago, we witnessed one of the fastest moves down in the history of the S&P 500. It fell from an all-time high on February 19th to a bear market low of down 35% in roughly 1 month. And I would note that all of the other major equity indices, both domestic and international, experienced similar falls. By the end of May, however, the market was up 36% from its low. A phenomenal rebound, still not anywhere quite near where it was at the all-time high, but a tremendous recovery. And I also note that as of yesterday, for the first time in history, the NASDAQ closed above 10,000. So the rebound continues to charge forward right now. But let's go back a little bit to March again. In that 1 month in March, it was the most volatile month on record for stocks, with an average daily move of 4.8%. That's 4.8% per day. By virtually any standard, that's gut-wrenching volatility. A lot of people refer to what happened in the capital markets toward the end of the first quarter as unprecedented, and that's probably about as good a word as any. But if what happened in the markets was unprecedented, so was the response. Let's put that into perspective a little bit. The combined stimulus from the relief programs enacted by the Federal Reserve Board, Congress, and the Treasury Department equate to more than 25% of real gross domestic product for this year, as estimated by the Congressional Budget Office. And there well could be more to come. Yes, it has been an extreme environment. Is there more to come? Maybe, maybe not. Uncertainty continues to loom large on many, many fronts. But regardless of what actually occurs, we would definitely recommend that we be prepared for more volatility. We should not be surprised by it. So the question becomes, how do you deal with an extreme environment? And I want to answer that question from the perspective of our working relationship with community giving and with the investment committee in particular. Now, I could be very simple and just say, ignore it and do nothing and focus on the long term. And that might very well turn out to be the correct answer. That would probably be a little bit too flippant for purposes of this presentation. So I want to modify that view a little bit. What I would say is what you want to do is you want to monitor what's going on in the broader environment. And then you want to see how that broader environment is impacting your particular portfolio. Then you should react in a thoughtful and deliberative manner. However, you want to be very careful not to overreact. And you also want to be very careful not to have a knee-jerk reaction. The key from our perspective is to view this type of environment, the one that we have been experiencing, as an acid test, and to evaluate your portfolio accordingly. It's one thing to be comfortable with your portfolio when everything is operating on an even keel. That's fairly easy. It's another to be comfortable with it when we have just pulled back from what many people would characterize as almost financial Armageddon. So the issue is the acid test. And I would like to focus on two aspects of the portfolio there. Its asset allocation and its investment vehicles. Let's start with the asset allocation. And I'd begin by noting here that the Foundation's approach to asset allocation is very much strategic and not tactical. We're not fans of making short-term tactical adjustments. And this is especially so in environments of extreme volatility, where the consequences of making a tactical adjustment and being wrong can be far more significant than they are in a more normal environment. Our approach is to rebalance toward the targets when the account becomes positioned outside of its stated ranges, but not necessarily to rush to do so, but to keep an eye on it, and use cash flows to move the account back towards its targets. Asset allocation is by far the most important part of an investment program, and should be based on the account's objectives. When we work with clients to establish an allocation, we model the likely results in both up markets and down markets. So the question in an asset test environment are twofold. One, were there any real surprises? And two, were the results within the client's comfort zone? Based upon our discussions with the investment committee to date, we would answer those questions as follows. In terms of number one, the answer is no. There really weren't any surprises given what took place in the broad environment overall. And number two, yes, the results that took place were within the client's comfort zone. And our simple reason for answering the questions in that manner is very, very concise. Nobody panicked. Nobody ran for the doors. People continued to have a high level of confidence in the investment program overall. But let me digress for a moment and talk a little about diversification, one of the key components of asset allocation. Now, the irony here is that diversification is least beneficial when you need it the most. There's an old saying in the investment field, in times of crises, correlations go to 1. And basically, that means there is no diversification in those times. It pretty much evaporates. And that's what we saw for the most part last March. Pretty much all types of investments moved in the same direction, straight down for the month. The only exception, as to be expected, was U.S. Treasuries. U.S. Treasuries held up. Everything else did not. So what lessons do you draw from that type of experience? Well, let me start by telling you what lessons you don't draw. You don't just pile in U.S. Treasuries, particularly because they're very interest rate sensitive and because the yield on the 10-year Treasury is now to roughly 70 basis points. You don't regret your positioning. What you do is maintain appropriate diversification, which tends to be beneficial in the vast majority of investment environments and which tends to serve your interests very well over the long term. Community Giving, as the foundation, maintains 3 investment pools, all of which are available to all donors. The strategic pool, which is the primary pool and the largest pool, a moderately conservative pool, and a socially responsible investing and impact investing pool. The asset allocation of all those pools is matched to their particular investment objectives. In the case of the strategic pool, the long-term targeted rate of return is 7%. That targeted rate of return is based on the grants to be made, the administrative and investment costs that need to be covered, and some allowance for inflation. Periodically, the investment committee reviews the asset allocation, and they plan to do so again later this year. While all the factors I have mentioned above will be reviewed, it's doubtful that there will be material changes in any of those underlying factors. As a result, some changes in the asset allocation are possible, but they probably will not be significant. Whatever changes are made, however, will be made and approved by the investment committee based upon a thoughtful and deliberative process with a long-term perspective. And hopefully, they'll be made once the extreme volatility that we've been witnessing is in the rearview mirror. Asset allocation is important, but the other major component of investment programs are the actual investment vehicles that are used, the vehicles in the program that are used to implement the asset allocation. And just like an extreme market environment is an asset test for an asset allocation, an extreme market environment is also an asset test for the investment vehicles, probably even more so. There are 3 types of investment vehicles in the various portfolios used by Community Giving. One type are index funds, vehicles that are designed to track a particular segment of the market, to generate a rate of return in line with a designated benchmark, to minimize any variance, and provide exposure to that asset class or segment of the market at a very, very low cost. Number 2 are actively managed funds with a defined focus, An example might be a large cap domestic equity fund that again is matched to a particular segment of the market, a particular benchmark, with the goal of doing better than that benchmark, outperforming it over time. And the third type of vehicle I'll refer to as tactical funds. These are funds with a broader mandate. They're somewhat more flexible. They have the ability to move into various segments of the market based upon their assessment of the market environment. How do you assess those three different types of vehicles in an extreme market environment? Well, differently. In the case of the index funds, it's pretty much a non-issue. That vehicle or those types of vehicles are going to track their respective indices regardless of how much or how little volatility there is. The market environment becomes somewhat more important in the case of an actively managed fund that is trying to outperform a certain segment of the market. And volatility provides an interesting opportunity to evaluate those funds. The third category, however, the tactical funds with a broader flexible mandate, are probably the most interesting to observe in this environment because there's lots of different opportunities to reposition those types of portfolios, and it truly is an acid test to see how these vehicles perform. Again, there is no real rush to judgment here. You want to take a step back and analyze how the various investment vehicles have performed when the market was crashing, and again, how they performed when the market was rebounding. But in this case, there's a little more to it. Up until the market collapsed in late February, we had been experiencing a fairly prolonged bull market. The investment results overall had been very, very good for quite some time. And over that time span, monitoring all the vehicles in the portfolio, some were performing better than others. Some were generating very good returns in the bull market, and some returns were a little bit more questionable. So for the vehicles whose returns were more questionable then, the recent market volatility really provides an interesting example. Did those vehicles distinguish themselves in the market downturn? Because if they didn't, then we were looking at a situation with some vehicles that had performed poorly during a bull market, but then had also performed theoretically poorly during a down market. Not a good combination. As a result, we have made a couple of changes in the portfolio this year, focusing primarily on a couple of the tactical funds whose performance was a little bit disappointing in the down market environment, and they really failed to redeem themselves based upon what was some questionable performance in the previous up market as well. We continue to review a few other vehicles in the portfolio, again with no rush to judgment, and maybe making some recommendations to the investment committee later on this year to review what's going on and possibly implement some changes, hopefully once the dust settles. We've talked about the asset allocation, and we've talked about the investment vehicles. Want to address one more factor though, which is always important, and I'd say particularly so in times of extreme volatility. And what I'm referring to here is cash and cash flow. And I would stress to begin with that we're not talking about engaging in any tactical endeavors here. We're not saying let's raise a lot of cash, we think the market's going down, and let's avoid that downfall, and let's be in a position to reinvest that cash when the market rebounds, we can participate in that rebound. That would be idyllic, that's the holy grail, but that's not the approach. What we're talking about is making sure that we have sufficient cash available or readily available to handle expected withdrawals and possibly even some unexpected withdrawals. What we want to do is monitor the cash in the portfolio very carefully and possibly raise some cash over time to make sure that we are sufficiently liquid. And we will potentially raise that cash through basically a reverse form of dollar cost averaging. The same way you would invest a lot of money in a portfolio on a gradual basis according to a preset schedule, you might raise that money on a gradual basis according to a preset schedule. That's an issue we are looking into and one we plan to address with the foundation and the investment committee over the coming months. But our goal here is fairly simple. We want to make sure that we do everything we can to avoid being in the position of needing to raise a substantial amount of money in order to fund withdrawals at a time period when the market is crashing. That's not what you want to do, and we want to try to avoid that. I would also note that in terms of actual experience, the withdrawals in the various portfolios so far this year have been rather moderate. In conclusion, in managing endowments during times of change and volatility, even during times of extreme change and volatility, which may very well reappear, we will continue to work with the portfolio in essentially the same manner that we work with the portfolio in all environments. We will focus on the long term. We will make sure that the investment objectives are appropriate. We will make sure the portfolio is positioned in terms of its asset allocation in line with those investment objectives. We will monitor the portfolio carefully, and we will react as warranted, but be very careful not to overreact. As we always tell our clients, the hallmark of our firm's investment philosophy is that we have a healthy respect for the markets, and we tend to be very skeptical of anyone who thinks that they can outsmart them. Bottom line, there may be some tweaks to the portfolio later on this year, but would not expect there to be any wholesale changes. Thank you, and I will look forward to your questions later on in the presentation.
Thank you, Shale. I'm Sarah Carlson. I'm the Executive Director of our Willmar Area Community Foundation. And in a moment, I'm going to introduce our second panelist today. But before I do that, I want to remind you that the Q&A tab and the chat feature at the bottom of your screen are both available to take your questions, which we'll facilitate just a little later. So our next panelist is Jeff Schultz, and Jeff is a Senior Wealth Advisor at Bremer Wealth and holds his bachelor's in finance from St. Cloud State University. He is a certified trust and financial advisor and an accredited fiduciary investment manager. Jeff has been in the financial services field since 2003 and with Bremer since 2007. Jeff has served on our Willmar Area Community Foundation board and chairs our development committee for the last 4 years. In his spare time, he enjoys doing anything his 10-year-old son, Teddy, is interested in at the moment. And he is also a running enthusiast. And he is attempting to run 2,020 miles this year in an effort to raise money for the WACF's Opportunity Gap Fund and Miles for Mentors, which is a Willmar-based nonprofit. Jeff, thanks for joining us and sharing your expertise today.
Thank you, Sarah. I was just going to point out, I think Teddy's still 8, though. I don't think I lost 2 years on him, so it gives me a couple more years with them. Thank you for that intro. My talk will be just a touch different than Shale's today. I'm going to start with a bit of an economic update and then spend a little time on the bond market and the stock market and wrap up with where we feel that leaves us in managing endowments or any money really in these volatile and changing times. So if you want to, Amy, move on to the next slide, that'd be fantastic. So here's a little start of an economic update. If we look at the top line, we can see the first quarter of 2020, GDP was down 5%. The forecast, we're almost through the second quarter of 2020, and the forecast is quarter over quarter, we're going to be significantly worse in the second quarter of 2020 than we were in the first quarter. And assuming that's all true, which is pretty much set in stone at this point, that will have meant that we are in a recession. So things are not yet getting better. If you look at the numbers on that top line, you see a big rebound in the third quarter of 2020, but that's coming off that floor in the second quarter. So that's not a 19% growth, that's 19% improvement over second quarter. So we look for second quarter to get worse in terms of real GDP. We expect unemployment to stay low and interest rates also to stay low for the foreseeable future into 2022. In terms of economic growth, we just ended in February, I think Shale, you said it, the February 19th, ended the longest expansionary period on record. You can see in this chart that it was at a little bit of a lower run rate. Historically, we started out with an expansion at 5.1. The next average was 4.4, 4.2, 3.8. So each growth period was getting a little bit lower, so lower run rate. So it wasn't shocking that this last cycle was longer than average, because even in that growth period, we're only averaging 2.2% growth. So the length of it wasn't that shocking when you factor in the lower trajectory. That just ended. And as I said, we do expect we're in a recession. And we'll find that out at the end of the second quarter for certain. jobless claims spiked up very rapidly. And that spike is indicative of how quickly and how severely the coronavirus hit us as a country, the entire world, and the economy. Now, the reason why the stock market doesn't look like the inverse of that jobless claims number is really a number of factors, but it's the fiscal policy, it was a stimulus, it was the CARES Act, the unemployment benefits. So all those things that got money into the hands of consumers kept that force of those jobless claims from having as extreme of impact as they otherwise may have. So those were very positive things. The Treasury yield curve, if we look at that top bar from 1 year ago when we thought interest rates were extremely low, Brad, I'm sure that you were in the same boat thinking when treasuries were at 175 that they couldn't get too much lower, and we're starting to maybe look for some improvement. And that all changed this year. Rates dropped dramatically from what we thought was already a fairly low point. The Fed cut its overnight rate to 0 to 0.25 target. They intend to keep it there until 2022 is the last thing we've heard. And that again reflects the expectations for really low inflation, slow growth. And the other thing that it does, whether it's intentional or unintentional, is it does spur risk taking in all forms. So if you were currently in a 2-year treasury, but you can no longer live with the 38 basis points you're earning, you might have to go out to a 10-year to get 71 basis points, as you see on the chart. If treasury rates can't get you there anymore, maybe you need to take on some additional credit risk and you need to get into non-government bonds. Maybe if the muni bonds you're buying can't get you there, you might have to dabble into equities. And so it does kind of push people out in terms of the risk profile that they're willing to accept, or maybe not willing to accept, but need to take to get the returns. As Shale said, to get 7% is not as easy as it was a year ago. The S&P earnings growth rate, it's really hard to quantify right now. We don't have any certainty around the coronavirus and its true impacts. And so the earnings growth rate has gone negative. The consensus is that next quarter will go even deeper negative and be somewhere in the tune of negative 25%. And that, again, very hard to quantify. It changes daily, and it really isn't that shocking to those of us who deal with finances on a day-to-day basis right now. And that chart might look kind of scary. I think the next one that gets into the PE ratios will maybe be a little bit more uplifting. So PE ratios are high right now, and there's a couple reasons for that. The prices, as Shale alluded to, we saw a dramatic drop in prices, asset prices, and they rebounded in almost as dramatic of a fashion. We're not quite back to where we were, but we're most of the way back in a very short time. And depending on who you ask, that may be a good thing, or maybe it's not sustainable and we might see a dip again here. We could debate that on a separate call. We do expect the earnings to potentially drop, which means the PE ratios are either going to go higher or possibly the prices would have to come down a little bit. Now, the big caveat to that is there's been so much Fed and fiscal policy enacted to support these prices that they don't necessarily need to make sense to us right now. It's not all driven by the consumer right now like it normally is. That can't continue forever. At some point, we're going to have to start to grow. But right now, the Fed has really helped to prop up the price so that the PE ratios can remain high, while earnings maybe are not as strong as we would like them to be. Looking at global equity valuations, these three charts have been on a different trajectory since 2008. The US recovered at a much faster rate than any other major markets. We're talking about developed, international, or emerging markets coming out of the Great Recession. So the US came out healthier, faster, at a much higher rate of return, and that trend has continued. And so we don't necessarily see that changing anytime soon, but looking at this, it would lead one to believe that there may be more value to be had, or just simply stated, international stocks, whether you're talking about developed or emerging markets, are currently cheaper than US stocks. This slide, I know Brad has one very similar to this, so you guys will get a good, healthy look at this. But I thought this was a really good perspective to share when we're talking about managing during volatile times. Quick math on this, I counted, and there were 5 years within these 40 years where we had a pullback intra-year. So during the year, we had a pullback of 30% or more. Like I said, 5 out of 40, I think that's 1 in 8, that's 12%. So 12% of the time we have a pullback like this. This isn't that unusual. As Shale alluded to, the speed at which it happened is what makes it so unusual. The scale of the pullback, not so much. The speed at which it happened and the speed at which the recovery occurred are what make it quite unusual. But it's healthy to look at a dot chart like this and see we've had years like this before. You can have a year that's down 28, 30% and still end up positive, or maybe the next year will be very positive. So it's not the end of the world. How we got here is different than how we've gotten here before, but it's a place we've been before, and we're going to manage out of it the way we've managed out of it before. The quilt chart is this is where I wanted to end, is kind of tying it back to this, and to draw your attention to the balanced portfolio, which is the blue box connected by the dots. We really believe that diversification, but proper diversification. So this is talking about balance. I'm not suggesting everybody should be balanced, but being diversified really takes out some of the extremes of portfolio management. So you see that blue box is never the best performing asset class. It's never the worst performing asset class. In most cases, that's what our clients are looking for. They're not looking to strike out 3 times out of 4 and hit a home run once. They're looking for somewhat consistent, reliable returns so that they can plan for their cash flows, for their needed withdrawals, and have some kind of normalcy to the returns. We really feel that the important thing that individuals, any kind of client, but especially when I think of endowments, foundations, nonprofits, long-term to an endowment is different than long-term to us as individuals. Shale and I, probably more than likely, both of us will be dead in 100 years. Most endowments will still be around. So long-term to us as individuals is not the same as long-term to an endowment. But you still need to make sure that your goals align with your asset allocation. Your short-term money, whether you're talking to individuals or endowments, should never be in the stock market. If it's money you're going to spend in the next 3 months, I don't care how excited Brad or I are about the stock market, don't put money you need in 3 months into the stock market. And if it's money that you don't need for the next 20 years, it should never be in cash. That's just poor asset allocation and poor decision making. So we think now more than ever, and Shale hit it very well on the head. We just went through kind of a litmus test, a gut check, whatever you want to call it. We went through a period of time where people got to see if their asset allocation was appropriate. And if you felt at the bottom like pulling out, and you didn't because you were prudent and you were smart, now is an opportunity to reevaluate that and to say, am I still allocated the correct way? We've gotten a rebound. I can now make an adjustment at a more appropriate price, not take a huge loss, because the volatility that we've seen, not saying we're going to go back to those lows, but the extreme swings that we've seen up and down, we think are going to stick around for a while. We don't think volatility is going away anytime soon. So to make sure your short-term assets are aligned with the short-term strategy, your long-term assets are aligned with the long-term strategy is of the utmost importance. I think that asset selection, so whether we're talking about using a mutual fund, actively managed mutual fund, a passive fund, an ETF, to me that's secondary. That's an implementation decision, and while it can make a difference in terms of basis points and return, that's a secondary consideration to whether the money is in stocks or cash or bonds. I think those things are more crucial. And then as a follow-up to that, making sure that you have a prudent approach. And being prudent doesn't mean having a crystal ball, and it doesn't mean being right all the time. It means having a process. It means following that process. So doing things like rebalancing. If you want to be 68% in equities, when things are down, you should still be 68% in equities. It's a good time to buy. When things go up, sell some and get it back in line. So follow that process. And from time to time, reevaluate that process to make sure it's still the most appropriate for you. And I think that if you're doing those things, then you're doing the best you can to manage your endowment or any kind of funds during volatile times, times of change, and really any point in time.
Thank you so much, Jeff, for that. My name is Carol Turno. I'm the Executive Director of Central Minnesota Community Foundation. It's my pleasure to introduce Brad Wheelock. Brad is a Senior Portfolio Manager and Managing Director and a 32-year veteran of RBC Wealth Management. He graduated cum laude with an undergraduate degree in finance and holds the accredited investment fiduciary designation. For 2020, he was ranked as the #1 wealth advisor in Minnesota by Barron's Magazine, The Wall Street Journal. For 12 straight years, he's been ranked among the top 1% of wealth advisors in the nation by either Barron's, The Wall Street Journal, Forbes Magazine, the National Association of Board Certified Practices, or Rep Magazine. It has been our pleasure to have Brad serve on our board for a full 9-year term, and I'd like to introduce you to Brad.
Good afternoon, everybody. So I want to start with both a thank you and an apology. A thank you for joining us this afternoon, and perhaps an apology because when you have a diverse, wide, big group, sometimes it's easy to unintentionally talk above or below somebody. So we'll try to hit this right down the middle, but there'll be opportunities in Q&A to ask more questions if we need to drill down any further. So with that, let's get rolling. Sometimes, you know, it's funny because people like me, they always want to talk about what happened. And if you're in the audience, you're kind of like, well, I lived that, you know, tell me what's going to happen. But sometimes in order to understand where we're going, it's worthwhile to just pause and maybe reflect on where we've been. So what you're seeing here in blue is the last 5 months of the year. So this is ending May 31st. What you're seeing in orange is the last 12 months. And so again, notice how distinct and different the returns have been. For example, in the S&P 500, as we start and work a little bit from left to right, in the last 12 months, it's down about 5%. But in the last 12 months, it's up almost 13%. As you kind of try to, again, gain some perspective from this, you can see that, again, domestic stocks outperform international stocks. Developed international, again, performed better than emerging markets. Commodities were kind of the worst of the group. And then in terms of fixed income, the higher quality bonds in the portfolio that an investor had, the better the return you enjoyed. If we look at, again, on a more, to the next chart, if we look at the opportunities in the last 12 months, for example, and if I isolate capitalization in the last 12 months, so I'm right in the middle of the page, for example, you can see large value produced a return of negative 1.64%, contrasted to large growth, which was up over 26%. So whether we had the portfolio invested in value or growth, even if we got capitalization right, created a 28% delta with investor return. And then in the same spirit, if I kind of draw a line around the 1-year returns and go down growth, if I got growth right, so I had the portfolio in growth, the return was again that same 26.25%. But if I missed on capitalization, the return for small cap growth dropped to 7.32%. And so again, the reason I want to illustrate that is because in community giving, one of the things, the core premises, and Shale touched on this, is the whole idea of asset allocation and diversification. And so in the perfect world, if we were smart enough to always get this right, we just avoid the bad and just enjoy the good. The candid reality is most people aren't. And so we want to have both of those in portfolios so that they kind of work like the pistons of a car. When one's up, the other one's down. And that continues again to try to moderate volatility. On the next page, you're going to see a long-term chart. So this is going back to 1925. And if we just reflect on the last 3 months, it's really kind of frustrating because it just, the volatility just kind of beats you to death, and married with all the other social issues and other reasons to get frustrated, it can kind of get a person down. But if you look at kind of history, so we're going now back to 1925. In the peach color, those are bear markets. In the green color, those are bull markets. And take particular notice of the amount of length and width for each of those cycles. As you kind of run that forward, eventually you wind up in the upper right-hand corner where you can see that the existing bull market or bull bear born again is again relatively short-lived, and we think has a significant opportunity ahead. One of the things that people want to do is kind of get a sense of expectations, and the challenges when you talk about volatility is if you're a donor, your philanthropic goals don't change. And if you're a 501c3 organization, a lot of times your expenses, don't go down with the whims of the stock market. And so what we're trying to illustrate here is kind of what's happened. And again, we're taking a very long-term approach. So this is going back to 1926. So in the tallest column, you're seeing there instances when the stock market produced a calendar year return between 10 and 20%. Everything shaded in left were instances when the market actually produced a negative return. So again, you can see that roughly 70% of the time the market goes up over a calendar year, 30% of the time it goes down. And I think what most people are alarmed with when you start talking about pandemics and things of this kind of magnitude is that whole idea of 2008 still stays fresh in people's minds. But if you look at the far left, you can see that there are only 3 times in history that the markets produced a loss of negative 30% or more. It was 1931, 1937, and 2008. So though 2008 was distinctive, you can see it's effectively tail risk, and so maybe even characterized as a black swan type event. On the next page, you're going to be able to, again, see in charcoal the benefits of what both Jeff and Shale talked about as it relates to kind of diversification. So in green are equity returns, in blue are fixed income returns, and in charcoal is a 50-50 blend. So in that first instance, what that's basically saying is that within any given 12-month period of time, a 50-50 stock bond portfolio could be up as much as 33% or down as much as 15%. But if you go all the way to the far right and you look at what it looks like on a rolling 20-year average, what that's suggesting is that on any given 20-year rolling average, it could be as little as 5% or as much as 14%. And so again, when you talk about foundations and endowments that have very long-term kind of horizons, it's so important to be able to kind of focus on that long-term because again, it's so easy to be distracted. Jeff shared this next chart, and again, if you kind of look at this just very quickly, in red, you're seeing the maximum drawdown in any calendar year. So again, if you look to the far right, you're seeing that in the first 3 months of 2020, the market was down 34%. Right now it's down 20%. But if we shift just to 2019, so one bar to the left, you can see at one point during calendar year 2019, the market traded down 7%. But if you stayed in and you didn't sell during that time, the market finished up 29%. So a real, again, good barometer for how volatile things can get. When we talk about volatility on the next page, you can see again, yeah, you're not imagining it. It's real. And so in 2020 so far, the market is 1.5 times more volatile than it has been in its 50-year average if we're looking at plus or minus 2% returns. If we expand to 4% returns, again, you can see that on average, that happens about 2 times a year. So far in 2020, it's happened 14 times already. So again, it's 7 times more volatile already. And so again, what you're feeling is real. Again, you can kind of see how that looked in retrospect on the next page, where you can see exactly what went on. So these are average daily moves by week. And so again, as portfolio manager, it was really interesting and frustrating, quite frankly, and maybe even more so as an investor, because intraday, stocks were moving what they would typically move in a year. So all of a sudden, 8% moves become commonplace. And again, this chart helps to kind of underscore how distinct and dramatic that was. On page 10, Shale touched on the idea of how fast this bear market, went down. And a bear market is simply defined as a 20% retrenchment from peak to the first 20%. And so you can see, not only was it one of the fastest times in history, it was the fastest time in history. What's equally distinctive is that it's gone up almost as fast as it went down. And for some folks, that's a little bit troublesome because you're looking at the world and you're saying, golly, You got restaurants that aren't open yet. I'm not sure if I feel like flying yet. I don't want to go to the gym. And you're saying, how in the world can the market be at these levels if there's still so much uncertainty that abounds? And again, I think what is important to remember is that the stock market is pricing things 6 to 12 months ahead of time. So really the question is, what's the amount of time ahead of now that the market is pricing economics into consideration? On the next page, you have, again, rather telling kind of story here. For perspective's sake, we just looked at, we talked about in 2008, one of the worst times in history, one of three where the market traded down 30%. To contextualize that a little bit, the US government printed $800 billion in response to the 2008 financial crisis. By contrast, in the last 12 months, the US government has printed $3.4 trillion. The numbers are almost staggering. They're kind of hard to even get your head wrapped around it. And Shale touched on the idea that there's current bills tabled that could inject even more stimulus as we head forward. So there's an adage in investing that says, don't fight the Fed. And right now what the Fed is doing is they are injecting massive amounts of liquidity into the system. Again, people like me, that keeps you up at night a little bit because you say, gosh, at some point we got to pay for that. This chart helps to, again, illustrate how we compare to both the Eurozone and Japan, who have been far more aggressive than even the aggressive position the United States has been. When you see QE, that's an acronym that stands for quantitative easing, and it's basically cryptic for we're printing money. One of the things that, again, kind of we try to highlight when we look at, how are things going right now in the, what you're seeing here are delinquency rates on all loans, and specifically in the lower graph, you can see that we entered this pandemic. So this is as of the end of March, I believe, as of the end of February. So we went into this pandemic in great shape, where the consumer just basically was making payments on all of their debt, and their delinquency was far below average. You see some of the same phenomena attributed on the next page, where you can see that the average consumer debt level was 16.4% versus 15.1% as we entered the pandemic. And again, if the consumer has a healthy balance sheet, and you can anecdotally talk to your friends, talk to your work colleagues, talk to almost whomever you want, and people will kind of joke, they'll like, gosh, I have the same $20 bill in my wallet today that I had in March. And that's because people aren't spending a whole heck of a lot. And so by consequence, their debt level is still very strong to this day. This next chart to me is I don't know, sometimes I think its value is more for cocktail conversations than it is substantive investment rationale, but I think it helps to underscore how bifurcated opinions can be. And so what you're looking at here is these are, it's basically a consumer confidence by political affiliation. So in red, it's saying if your political affiliation is Republican, 77% of the people are very positive or have a positive economic outlook. By contrast, if your political suasion is Democrat, only 32%. And so again, it's not right or wrong. It's just that when you look at it, you say, how can the market be at these levels, or how can some people be so concerned about the virus and other people aren't? You have this level of, again, very profoundly different opinions. And again, there's not a right or a wrong answer. There's not a right or a wrong opinion. I just think it's interesting and helps to highlight kind of why we're in the conditions and opinions are so bipolar and so strong as they are today. Jeff touched a little bit on valuation, but what you're seeing across the spectrum, and I apologize, maybe a little bit hard to read on an iPad, but what it's suggesting is that whether it's the S&P 500, whether it's the Russell 2000, IFA, international stocks, Europe, Asia, big companies, small companies, almost categorically, not almost categorically, PE levels, which is just one measure of valuation, PE levels are near a high. And then lastly, I want to take a peek, and again, Jeff had kind of touched on what the yield curve looks like. So in today's world, you can see again in the blue what it looked like 12 months ago and how it's gone down so profoundly as we've kind of edged forward. When you look at the world and you say, gosh, the 10-year Treasury stands at 70 basis points, and the 5-year Treasury is maybe around 30 basis points, and you say, boy, if there's investment committees around the country looking at that and saying, what should we do with our money? A lot of times you're like, gosh, it just doesn't make any sense. And so what happens is they'll wind up migrating towards stocks because effectively it becomes the prettiest of the ugly alternatives. And so that's just kind of a quick overview, kind of a trip down what has happened, what we think will happen. With that, I'll turn it over to Sarah for questions.
Well, thank you to all of our panelists. That was enlightening. I do have a few questions ready to go. And I think the first one I'm going to queue up might be suited best to Jeff. So Jeff, if a nonprofit needs cash for operations, how would you recommend their board decides whether they should borrow, they should take from endowment or reserves, or what another strategy might be? Jeff, I believe you're still on mute.
Can you hear me now?
We can.
Perfect. I think that question would be, I'd have to ask a follow-up question in terms of what are you looking to spend money on? And I think very similar to how I would approach it with a individual client, if we're talking about an asset that's going to appreciate in value or is in some way, shape, or form an investment, then I think you look at possibly taking it out, or excuse me, if it's going to appreciate, you look at taking on debt possibly to finance that. If you can cash flow the debt with interest rates, that's a positive, interest rates being so low. If you're a borrower, that's a very good thing. And so it's a good time to lock in some term debt if you're going to buy some real estate or something like that. Now, if we're talking about making payroll, that's maybe not a good fit. Maybe then we need to just think about, if we have reserve funds, this is why we have reserve funds. And should we sell across all asset classes and just raise cash, or is now maybe a good time to take it out of stocks if we think we're a little bit overexposed to stocks in the long run and we plan to leave the rest of this money invested? So I think there's a few follow-up questions there, but it would depend probably to me first on what exactly are we paying for. But certainly, just historically speaking, if you're going to have debt, it's a good time to take that debt on and have a fixed rate.
Thank you.
Brad, if you want to elaborate on that at all, or if you have any additional thoughts.
I think, again, we always look at the debt as the hurdle rate. So if the interest rate is 5%, that means your investments need to produce a rate greater than 5% in order to justify it.
Thank you, Brad. This question I think might be interesting for you to take a crack at first. And that is, do you have, or is there a prediction in the industry at this point about what inflation will look like long term?
Sir, is that directed to Brad or to Jeff?
To Brad.
Sorry. So I think, one of the things that you typically get when you print money, and we saw it in 2000, the byproducts of that are typically higher taxes and inflation. So in 2008, we printed a bunch of money, really saw no inflation. And so now you say, well, gosh, if we printed the amount of money that we just did, it seems almost logical to think that it's got to happen. I think that the reason you're not likely to see immediate inflation is because every other country on the planet is doing the exact same thing. And so effectively, the baseline is increasing. So I would expect very benign inflation going forward.
Thank you. I think we have time for one more. And Shale, this one I'm going to send back to you. And that is a question about recommended asset allocations for long-term endowments, and how should people look at endowment payouts at a 3, 4, 5% range?
Very good question. Typically your asset allocation is based upon your overall spending policy, and your spending policy is comprised of the amount is going for donations, your administrative costs, your investment costs, and some sort of allowance for inflation. And those figures, as I mentioned during my initial comments, tend to be fairly sticky. I mean, there's a certain amount you have to give out as far as donations, or no one's going to put money in the foundation. And there's a certain amount you need to cover your administrative costs, you can't operate. And you can try to get investment costs very, very low, but there's just certain realities that are still there, even if you bring costs down and index a good portion of the portfolio. Inflation tends to be the biggest variable. And you're normally getting pretty aggressive if you budget much lower than 2%. I mean, the long-term rate's been around 3%. We've been below that now for a number of years. I would concur with Brad that at least for the next few years, the rate's probably going to stay pretty low. That's what the Fed's projections are. Longer term, with what now a $23, $24 trillion deficit, that's a whole different ballgame. But as I've often said, nobody cares about the longer term anymore. Longer term is the election in November, and that's about as far as you get anybody to focus on. So you're looking at that targeted rate of return right now. Most of those targets for endowment funds are coming in around 7, at the most 7.5%. It used to be you'd see a lot of returns around 8%. You're not seeing those anymore. Nobody can realistically model for those given the expectations for where we're at in the current investment cycle. That's for endowment fund. That's true for long-term pension funds on that. But even, and I think as Jeff mentioned, trying to get a 7% return now is challenging. With where we are in the fixed income markets, it's going to push you into a fairly aggressive allocation on the equity side. You simply have no choice if you want to generate the rates of return you're looking for, but that is going to subject you to a fair amount of volatility. So I think this is where we're at right now, and keep the seatbelts buckled, because that volatility may very well reemerge sometime in the next 3, 6, 9, 12 months from that. We wouldn't be at all surprised. But you can't go hide under the mattresses. If you do that, you're going to get basically zero given where we are on the fixed income side. So I think virtually all endowments are going to maintain a dominant equity allocation, but it's going to be a rough ride.
Thank you, Shale. Thank you to all of our panelists. At this point, I'd like to turn it over to my colleague, Holly, with the Alexandria Area Community Foundation for a word about our response funds.
Thank you, Sarah. So thanks again to all our speakers and our guests today. Thanks for joining us. I'm just going to give a really brief update on the response funds that we currently have going. I'm going to speak to the 4 largest partner foundations, the Alexandria, Brainerd, Central Minnesota, and Wilmer. And as of now, we've given out about $350,000 in grants to nonprofits over the last 2.5 to 3 months. But we still have dollars in those response funds available. So the count that I had today was about 388,000. So those grant committees are still actually receiving funds. And so they are available to continue to seed and give to. And the grant committees are continuing to meet. Some are meeting weekly, some are meeting bi-monthly. So I guess my suggestion would be, if you have a question, please contact your executive director in your area. So let's see, I think with that, we'll just make it brief and turn it over, I believe, to Steve.
Well, thank you, Holly, and thank you to our presenters today, to Shale, to Brad, and to Jeff. We really appreciate their expertise, and especially when we're experiencing the kind of volatility that we've seen. So it's good to know that we have experts to go to answer all of our questions. We want to thank all of you for tuning in today. And again, thank you if you happen to be a nonprofit for the work you're doing on the front lines addressing community issues during these difficult times. Also, if you're a donor, want to thank you for your generous support for many different charities, and we appreciate the ability to work with you. If you have any specific questions about the investments and how we invest funds through community giving and our partner foundations, feel free to reach out to myself or Elise Wiener, our Director of Finance, or we can put you in touch with any of our speakers today, or specifically the executive directors serving your region. We are always here to answer your questions and here to help support you in your work. If you do have some input or ideas about this webinar series, we ask that you send us an email at info@communitygiving.org if you have ideas of things we might cover or go deeper on. Also, all of our resources and this webinar series, all of them, are now available on our website at communitygiving.org/COVID-19. So please check that out. If you missed a webinar that you'd like to see, all of these are recorded and available for you to view. So once again, we want to thank you for the good work you do in the community as nonprofits or as a donor, for the work you do in providing support. These are challenging times. Normally I'd be announcing next week's webinar, but we actually are going to take the next 2 weeks off because it is the 4th of July and we know people will be busy. And we're going to be back in July, I think it's 16th, and we'll be back with another webinar specifically looking at some of the key community issues that our communities are facing right now, in particular around the issue of race. And we're looking forward to some community conversations as we look to all build bridges and bring our communities together. So thanks again, and we wish you all the best.